Okay, I just saw a chat mention of that. Well, happy summer, and thank you very much for the invite. My name is Samantha LaDuc, and I am founder of LaDucTrading.com, also CIO of LaDuc Capital. And this, good, you can hear me now. This is obviously a presentation on advanced options. I have a fabulous trading room moderator by the name of Archna. This is a woman-owned and operated business, so I am very excited that she came in and I saw her talent in this area of identifying tactics to support my analysis, both macro and micro. And she not only serves as my trading room moderator, but also helps and supports clients in their trading as well. So my focus, if you will, is macro to micro, and that just basically means that I use a backdrop of macro and lots of other modalities to support my trade setups. So I'm looking at the big picture, but I'm very much focused on market moving news and scanning and synthesizing all that is happening both on the economic front, political policy front, as well as pattern recognition and volatility. So my thing is I trade for a living. I support clients who do the same. And I run a trader education service, mostly for retail, also trading research for institutional. I run a live trading room from 9 until 12. I also provide brokerage triggered trade alerts. So every trade that is entered and exited is actually being triggered from Interactive Brokers. So you get all of that, as well as my big picture analysis as it relates to the macro fundamental sentiment, technical, intermarket, and quant view. I am not singularly threaded. I am very much a solid generalist. I like to know what's moving, why it's moving, and then I put it together in a way to identify how best to trade it. This is very much technical in nature as it relates to setting up a trade, as well as how to enter and how to exit. Options obviously are to augment that trading strategy for those who trade options. Not everyone does. Some are very happy with stock, and that's perfectly fine. We base our trade setups on the underlying, whatever that asset class may be. And I am cross-disciplinary, so I not only have lots that I'm trying to contextualize as far as data, but I also am trying to identify on different time frames, because folks like to trade stock or options, futures, if you will, and some are short duration. I consider short duration, a few hours to a few days, and then swing trading a few weeks, and then trend trading a few months. And in particular, I really like financed call spreads for my trend trading, and we'll talk about that a little bit more. So my focus, and if you are a follower on StockTwits or LinkedIn or Facebook, or mostly Twitter, then you'll know that I am very much focused on volatility and market timing. I like to, as a colleague put it, kind of merge this macro background using kind of institutional knowledge as part of a solution of encapsulating a trade so it can be managed, with risk-defined options. And that's what I like to do. So I like to take that macro approach and then distill it right down into a chase, a swing, or a trend. Doesn't matter to me. I am very excited to do all three time frames. So kind of getting into that focus again, I'm looking at a macro fundamental backdrop and then applying technical intermarket analysis and sizing up, if you will, that option typically in a defined risk manner. We'll go into kind of how that looks, and then Archna is going to come in a little bit and talk about recent examples of trades that we have implemented, from Gilead to PINs, which is pin to interest. So lots of different particular vehicles, if you will, that can be used in a finance call spread kind of way to leverage a particular bullish bent and also to manage risk. So one of the things that I do is identify tops and bottoms, and I'm really comfortable doing that. I'm actually much better at timing tops than bottoms, and I happen to like financed call spreads as a method of buying low and selling high. We'll talk about the mechanics of that, but the point is, it's not something that I'm doing very much in reverse, not at all. So I like to short the market very much when I see a reason to, but the finance call spreads I am definitely placing as it relates to a bullish bent, because the market over time goes up more than it falls, right? The escalator and, elevator metaphor. So, it falls 67% faster than it rises. But the fact of the matter is, over time, the market goes up. So I like a finance call spread to kind of capture that trend, if you will, higher, and then take positions, risk off, and add volatility plays long when I see the divergence that's happening in the market for a pullback. So I'm really focused on that. But people think that I'm structurally bearish. It's not true. I just happen to like to look at risk. And for me, being able to tell when a market's going to pull back is value add for my clients. But I also know the current is going to keep running bullish over time. So when I feel like it's comfortable, it's settled down and it's going to turn and go back up, that's when I put on the finance call spread. So I hope that makes a little bit of, sense. These are the time frames in my world. So this is how I segment my trading activity. I actually have these different books. So my portfolios are live and they're based on these time frames. So, are we chasing, for example, Spotify today, or has it actually been a swing from $154, or has it been, a trend trade for a year? The point is, there are different times to choose options based on duration. So there are three things that go into options in my brain anyway: time, volatility, and direction. So first and foremost, understand that I'm not a premium seller. I am not collecting income. I have a very high conviction about direction. I am a volatility trader, which means I pick a direction and then I load slowly into that direction. But my thesis is to time market turns, that's directional. It is to follow sector rotation or money flow, that's directional. So that makes me a volatility trader. I'm not working with selling of options just to collect premium because, the market's not going to move or the stock's not going to move. No, that's not how I work. A finance call spread allows me to work with that decaying theta, that decaying option, if you will, for the sole purpose of leverage. So I want leverage in that option tactic that will allow me to have a much bigger ROI. So that capital that I'm putting in to that finance call spread, I have a high conviction of the direction, first of all, but I'm using that selling of premium in that tactic to get the biggest ROI. So hopefully that makes sense as well. But these are the time frames. Again, chases, they last typically 1 to 3 days for me. And I employ options that are 1 to 3 weeks out. Swings, they're 1 to 3 weeks long. In other words, I expect that the direction, some volatility will come into that instrument, whatever that underlying asset may be, commodities, rates, stocks, I don't care. And then it's employing options that are 1 to 3 months out. And then trends, I'm looking at something that's a reversal and it's going to be there for a little bit. So we got 1 to 3 months, and I'm using slightly further dated options 3 to 6 months out. So I'm not looking at investment where it's a 1 year, 2 year, 3 year kind of thing. I'm not a money manager, so I'm not managing a portfolio of other people's money where I have to do all that delta hedging and all that long-term, capital gain calculations. Nope. I'm in it for short-term gains, but this is definitely based on 3 time frames. I don't do finance call spreads on chases. Way too risky. I don't do them even on swings, although I know Archna does. So her risk profile is a little bit higher than mine. I only do them on trends. I really like them on trend plays because to me, they are more of a set it and forget it. I have a directional bias. I'm not looking for big volatility to come into it. I'm looking for a smooth, steady uptrend. And basically, I am just looking for leverage on an option tactic, and finance call spreads are my tool of, choice. So I showed this once, and there's a lot of wiggle room on this, but to get a better feel for how I do option trading myself, and everyone has to have their own, look, their own, their own mind, their own favorite trading strategy. These are mine. So my general, and I just kind of went over that, I get 2 hours, 2 days, 2 weeks, 2 months. For me, finance call spreads are going to be in this 2-month category, okay? And I might start out with a position size that's 1.5 times available equity, and that's it. So that tells you how much I'm willing to put into a trade. No more than 3% of available equity, excuse me. So right away, you're going to see that, 1.5 is not, for a finance call spread, is also something where I know it can go against me, but it's smaller size. I'm comfortable with it. I can still set it and forget it. It's not such a big position. I think that's really a big difference because some traders, they have 10 positions and 10% in each trade. I don't do that with finance call spreads any more than I do with directional trades. Okay, so this is how I am sharing position size, and that's my comfort level. So that's why I can say it's a set it and forget it kind of trade. Major important question to ask yourself, and it has to be realistic goal, not pie in the sky, is based on the strike prices of the options. Is it realistic to achieve in that time frame? So if something's, trading at 150 and you want to put 160 as a price target for whatever, tactic, is it realistic it's going to go there within the time of your option tactic? And this is my thing. I'm very price driven. In other words, I have a profit target. I have a stop loss. I envelope, if you will, the trade because I know where I'm comfortable. In other words, I'm long and strong. I'm wrong and gone. So I am for me, it's very important or comfortable or, to have that safety of an envelope around price targets. So the biggest question though, since I have comfort with that, is can it be achieved within the time frame that I'm allowing for that option, right? And again, it kind of goes back to this, how long am I going to be in this trade? So a recent example I'm going to give you is I placed back in Gilead trade back in May, and it was with July or August. It was a finance call spread. I can't remember, Archna. Do you remember if it was July or August? In any case, I know it was May, and I know it was at least July, maybe August. And the next day or the next week, it basically hit price target. But that was a surprise. It was not expected. So allow enough time for basically that theta decay to benefit the price of your option in the strikes that you are selling. So anyway, and this is definitely some areas. Oh, thank you very much. It was April 16th, and it was a July trade. So that to me is a perfect time frame. And again, we'll go over that. Archna will go over that in detail. But this is how I do it, and I wanted to kind of share that. I trade small but frequently. I trade momentum, both directions. It's a percentage of my book because it can be fun. It can be also good hedges. I just put on some volatility hedges, today. So that's not a big percent. My swing trading book is much bigger, and I'm looking at volatility coming into the market. So whatever it is, stock, index, asset class, I'm looking for overbought and oversold and, those reversal signals, but definitely swing time frame is bread and butter. So where do I use finance call spreads? value plays. I am, if you look at my website, you'll see I have a fishing theme. And, you know, that's why I call this bottom fishing. Setups are extremely oversold, or maybe macro themes. They have a trend time frame, which means, you know, a few months, 1 to 3 months. Then I want to put on a finance call spread, and I will, you know, check in on it, see if it's still working. But I'm not going to mess with it very much, because I have it, unless it breaks my support level, then I'm just not going to mess with it. I'm going to let it go. So that's how I work it. I have, I think, some flexibility in my head. I like to lawyer the trade. I look at both the bull and the bear arguments. I don't get married to either side. I have some major, you know, bearish economic views, but I don't let them get involved in my book. I am mostly long, which actually frightens the heck out of me right now, going into the end of quarter. So I won't be mostly long by the end of June. But the point is, I will look at both. If the market's going in a particular direction and it's supportive of a sector rotation that I have, I'm very, for the most part, skilled at seeing when we have inflection points. Even last Wednesday, that 5 standard deviation move in the SPY that we had on Thursday, I saw that the day before. I put on, you know, heavy puts in SPY, EWZ, had VIX calls, and we had a big drawdown, very sharp, very short. I covered everything at the end of the day because I felt and I saw that we were having distribution or selling underneath the surface. We were going to have an event, but there was no way that I felt that through options expiration, we were going to move very far outside of an expected move. So it was a trade. So I have a feel for when volatility is going to come in, and but the swing book is obviously still directional. I hope that makes sense. So Archna, if you can take over and go over these charts that we put together to kind of dig in a little bit more detail on particular mechanics of finance call spread, and then I'll pick up at the end and we'll do a little bit more.
Hi, this is Archna. So let's go ahead and look at finance call spread that Samantha likes. It's her trend play. I usually use it as a swing play, and it comprises of 2 trades merged as one. So when you are bullish a chart or a stock, you can buy a call spread, and then to finance that, to offset that cost, we are either selling a put or selling a put spread, depending on how much margin is required and how comfortable we are shelling out that margin. We either sell a put or a put spread to offset the cost of the call spread that we buy. So that it is actually 2 trades, 2 standalone trades. You can actually just sell a naked put or sell a put spread on its own. That is a bullish trade. Then you buy a call spread on its own. That is also a bullish trade. We are combining the 2. That is the reason we call it a call spread financed by selling a put. And then yeah, sorry. So why would we do this and why would we not do this? We are doing 2 trades together. I am selling a put spread, collecting that premium to finance my call spread. So with that, what we are doing is we are reducing the risk. How we are reducing risk? Because the amount of debit I am paying is less. Once I'm paying less debit, in my mind, the risk is smaller. Even though I am putting some margin, the margin is just put on hold, which the moment I get out of a trade, that margin is released. So I am not considering that into the risk because I manage my trade or defend it. I am not putting my margin at risk ever. And that is the reason in my mind, even though margin requirement is a con, that pro works in my favor. I am reducing my risk by reducing the amount of capital I am putting for the trade. Now, because I'm putting less capital, I'm risking less capital, I am giving less debit, paying less debit, I have a higher ROI. Now, it is a set it and forget it trade. I don't have to sit by my computer all day. I have a defined stop where my thesis is either wrong or it's not working, and I get out of it, and I can do it at the end of the day, or maybe once a week I have to look at it. I don't have to sit by my computer, and it is a set it and forget it kind of a trade. So that's good for anybody who wants to even trade part-time. Now, there is a con of assignment. What is assignment? If you're selling a put, it means that you want to get long, or you want to buy, you would have to buy that stock at that price. So if it becomes in the money, you sell a $20 put and the stock goes below 20, you can get assigned that stock. I don't wait that long, so I don't consider assignment margin as my cons for this trade. The amount of margin that is required for selling a put is pretty high. So you can do it for high price stocks. I will tell you how we calculate an overall margin, and that will define in your brain how much, yeah, above $50 I don't do. At the most $100 stock is what I would go for. That is amount I am willing to shell out.
And my little tweak to that is that I definitely don't want to be assigned the stock either, but I'm not afraid to if it's one that I really want. So if I feel this, I don't want to say a kind of active investment thesis. So I see an event coming, or it's oversold value, and I really believe that this is, going to maybe take some time before value managers come in and bid it up, or I'm waiting for some event, maybe it's potential M&A, whatever. So I don't mind owning the stock. So if I'm wrong in the finance call spread, or something, happens with a release, or they do an offering, or some bad news hits, then I have the risk of getting assigned, right, by that expiration if the price, is not higher. So I don't have to close that finance call spread if I have time on my side. But my point is, only do it. I guess my point is, only do it if you are not afraid of owning the stock at the strike where you sold the put.
So over here, I'm just showing this chart, which is of pins. I took this chart on 6/16, so it's just 2 days old. It is breaking the trend line and gone higher, and now it is targeting the next trend line over here at around $26, $28. So you have clear resistance, you have clear support, and you have all the moving averages that are below. So with this defined structure, I can easily buy a $23 call, sell at this resistance at $26. That makes it a call spread. 23 to 26 is a call spread for $3. And I can sell below over here, all these moving averages that are there, I can sell it at 20 put. And I have an example in the next slide, how much it costed me. So on 6/16, I could buy this 23-26 call spread for 90 cents. So I could do this trade by itself. So I could buy this 23-26 call spread for 90 cents as one trade. But what I did was I sold the 20 put, because 20 strike is below all the moving averages, and I was getting 75 cents credit for selling the 20 put. This is for July, okay? We are looking at July expiration. And so 90 minus 75, I am only paying 15 cents for this trade now. Now, if by July 17th, pins closes above 26, I make $3, 23 to 26, which is the $3 wide call spread. I can make $3. by paying only 15 cents. The $20 put will expire worthless. So that's 75 cents I get to keep. Now I'm selling the naked put. There is margin involved. This is the formula for it. Now I don't want to go into complicated calculation, but the easiest way to calculate the margin is going to be, I am selling the $20 put. So multiply by the 10, so it is $200. And how much am I getting? 75 cents for it. So that is going to be another $75. So approximately $275 is the margin that I have to keep. So $20 is the put that you're trying to sell. Multiply that by 10. It is $200. 75 cents, multiply that by the, each option contract is talking about 100 shares. So multiply that by 100 and you get 75 over here. So 200 plus 75, that's the max right now. When you start the trade. Now, if it goes below today, if pins goes closer to 21, then the margin will keep increasing, but we are not looking at that. I'm just looking at the initial margin required. So the max will be 275 that I have to pay, keep on hold. And I paid only 15 cents for this. And today itself, it was at $21 or 20 cents when I priced this in. Now it's at 23, about 23. I think pins is about 23. So I'm already making money on this. And my 75 cents that I sold has reduced. I can, if you think that the market is dicey and you want to get out, you can get out of this $20 put that you sold. You can get out of it at any time. We did Gilead in April that Samantha talked about. We were seeing a lot of activity, and so we had taken an $85 call spread and we sold a $65 call, and the net debit was 0, which means the amount of credit I got for selling the 65 put was the same that I had to pay debit for 85 call spread. And the very day that we put that trade, there was a news that their drug can be used for coronavirus, and it skyrocketed to 86 the very next day. We were able to get out at $2.50 the entire trade.
Now, this is never going to happen again. Let me just put that out right here, right now. This was a once in a lifetime type of trade. I've seen some really nice percentage increases, but never this. And I have to, you can see this literally. This is on my website. Archna and I are in my live trading room, and I'm like, oh, Archna, I want to do, a July finance call spread in Gilead again, because I happen to like the chart. I like that it's, based for such a long time, a few years. It does have, the coronavirus potential buzz, but I just really liked it for July. So again, April 16th, a July finance call spread. No idea that it was going to have this, news release after hours. But in the trading room, this is actually the recording of the trading room where we're going through and she's pricing out the tactics, right? Because I'm looking for the envelope. Here's where I think it's going to go. This is where I would, not want. I'd have to defend it, or it'd be in trouble if it fell below. So I think it was a 75 by 85 call spread selling $65 puts. And it was like $73 at the time, kind of where it is right now. The funny thing is, literally, she suggested not just selling a put, but selling a put spread. It reduced the ROI even further down, the cost basis even further into, a small debit, like a penny. And the fact of the matter is, this is an absolute once in a lifetime trade, but it shows the power of this move. I keep playing Gilead. I have one open right now, another finance call spread. that went up to 700%, and now it's back down to 250% ROI, but I'm going to wait. So it's a July or August. So I'm used to this as something that will raise and lower, with market conditions, but over time, that theta decay in the sold premium plus the bullish trend, it typically works in favor. So anyway, if you want to see that, it's very funny. We're literally talking about it in the trading room. Like, I like this. What do you think? And she's like, how about that? And I'm like, sure. All right. Sorry. Let's continue.
So what is the finance call spread? We talk. Okay. So
no,
currently we have
here.
So the entry checklist for this kind of a trade is you should be bullish. The stock, your thesis is bullish, and you have to have a bullish chart. The support resistance, I showed the pins. It has a defined support. It just moved above one of the support lines. And there is a resistance, the triangle and the trend line, where it could easily find some resistance. You are going to buy and sell at liquid strikes. What do you mean by liquid strikes? It has to have good volume and good open interest. Yesterday, I can give you an example of not liquid, is Ring Central. I did a call spread day before yesterday at Ring Central. And yesterday it went to my price and I'm trying to get out and it doesn't let me get out. There was very little volume there. So don't select anything like that. I am giving my example because it was such a nice chart and I took it, and I'm expecting it to work till July, but it did what it did yesterday. So I'm like, okay, let me get out, and it does not let me get out. So please look at what the volume is. If nobody is trading it, then it's very difficult to get in and get out. Rich premiums is relative with the volatility that it is right now. You may not be able to get a lot of premium and hence pay a debit for these kind of trades, but you may not have to go very far. If your chart is, and you're looking for an oversold bounce, like Samantha said, the moment there is a bounce, we sell below. And so I don't have to go very far. Pins was 21 something and I sold 20. It could easily reverse over there. So I'm not, if I look at the selling premium strategies that people do and look at the 20 delta or 16 delta where they sell, I'm not looking at that. And I am trying to sell just below the support there. I'm very comfortable with. And of course, price targets are achievable within the time frame. We give ourselves at least 2 to 3 weeks is what I am looking at. Samantha sometimes takes a month or two kind of. She would even do it August. I wouldn't do it right now.
Yeah, you're a few weeks. I'm definitely a few months. I feel much more comfortable with, 3 months out for a finance call spread. I know you're comfortable with 3 weeks. I'm not. It's different. It's different styles, but then you're actively managing it and you know that I'm not. So.
Yeah, and so don't mind losing premium paid and owning it if wrong. That's a way of saying that please don't try and do this on Hertz. Okay.
Yeah.
That's just a way of saying that you have to be comfortable owning a stock. You don't have to actually own it. You can put your stop to a place where you don't have to get assigned, but just don't go for those kind of plays that are, yeah, Hertz.
But it can still happen because there are still, there are examples where we actively traded Luckin Coffee, LK, and then it went, into delisting mode, and now it's back. But the point is, stuff can still happen. So I say that my favorite saying in trading is, don't risk anything more than you're willing to lose. So if you do a finance call spread, you just really have to understand the risks, which is assignment if something goes wrong. That's it. And if you're active, Archna's, managing and defending with lots of other strategies. I'm not. I'm letting it sit there. So it's personality, right? It's margin for sure, account size and activity. but also this is real. Things can go wrong. So you have to think about, how you're going to feel if it goes wrong. So I'm just trying to, mom radar. Definitely take the risk if it's educated and if it's comfortable for you. But these are the three things that I think are very important, which is margin, owning it if it's wrong, for sure, and knowing how to defend it if it does go against you and you really feel like you need to do something. Archna is, again, she's in my trading room. She also in the afternoon, she runs a trade management and options education class. So that's what she's teaching. I'm doing the analysis. So when you ask in chat, how do I find these trades? That's my job. I mean, I'm not using any scanner. I am extremely busy in analyzing stocks and asset classes and writing about it and trading it and setting it up for clients on different time frames. So I have, let's say, a very strong familiarity with certain stocks and asset classes that I will just go and understand, if you will, how they work. And Gilead is an example. There are others where you can still do this, like pins looks, really good, and it was a little bit more aggressive finance call spread, but you can do it on lots of vehicles. Just, make sure the bullish checklist, is in place. And let's see what else is on here. Oh, here, Archna, trade management.
So how do we trade? Once you get in, you have to get out, right? So you have to manage your trade. We, in Samantha's trading room, if I put a trade for Samantha, we are trading it as one thing. Even though there are two parts to this trade, call spread is separate and selling the put or a put spread is separate. We buy it together or we enter it together and we get out together. We consider both parts as one. When the support or stop is breached, we are out of the trade. If the price target gets hit, we get out of the trade, entire trade. So that's how I manage it for her. The main risk over here is eliminating the assignment risk. If I know, right, if I am having the pins trade, it's live in my trading account right now. If pins was supposed to reverse and go down, I would keep those two call spreads and the put spread put separately. I consider that separately. I would defend the naked put that I sold separately and leave the call spread for it to work whenever it has to. So the two ways you could do is just buy a $19 put and make it a put spread. So instead of having $300 margin, now I'm just having $100 margin, buying power reduction. So you could just manage it that way, or I could roll it. If the market turns around, the volatility increases. With volatility increasing, the premiums will increase. So rather than just keep it to July, I can roll it to August for higher credit. And then the assignment risk is put for a later date, because if you have 2 months for expiration, even if you are in the money, most likely you are not going to get assigned. Very rarely it happens that you would get assigned if you are 2 months out. So that is how different ways you can defend. But for Samantha's trades in the trading room, we just consider it as one trade with two parts. Once the stop is breached, just out of the trade. It didn't work, move on to the next one.
Yep. And that's how the mechanics, if you will, work, and different strategies of Archna's style. She's defending actively. I'm set it and forget it. She's doing a shorter duration, few weeks. I'm doing a few months. So there are different ways, but they're, again, I think hopefully kind of a tool for your toolbox to consider. Some other things to consider, though, for me, it's great for trend trading, but I really want to emphasize it's if you have a swing trading environment and this sector or stock, is on the uptrend. Buying at highs is not such a great idea. In other words, if it's bottom fishing or it's a pullback to support, this is a much better strategy than if it's a breakout and it's in all-time high blue sky area. Also, as Archna mentioned, the more expensive stocks, I don't mind that. She's like 50 is her limit. I don't mind if it's 100, 150, but the point is the assignment risk is definitely bigger. So less time to manage. You're working with decaying options. If you desire a higher ROI, but you're not afraid of assignment, if wrong, that's it in a nutshell. And I will then,
I'll just say one more thing.
Go ahead.
Neither Samantha nor I would do something on Tesla like that, because you're looking at the margin requirement.
Yeah.
Okay, it's a 900 and it was $1,000 just yesterday. So you're talking about it's going to be 1,000 times 10, which is 10,000. Plus, if you're trying to sell a $900 option, you're adding
Oh, you're 100% correct. Yes, yes.
So it would be almost $15,000 margin to play Tesla with this kind of a tactic. Nobody's going to try and do that.
Yeah, so exactly. So even though Archna says like under $50, I'm okay under $150 stock price. There's no way I'm going to do this on a Tesla. Correct. So in our kind of divide and conquer, as I mentioned, I run a live trading room, and my focus is very much synthesizing, scanning, not just market moving news, but also giving my analysis of swing trades and trend trades, especially as it relates to when I foresee inflection points, market volatility coming in, so that clients can better not only anticipate how to protect their portfolio, but also some of the trade ideas like a Gilead, or there were some others that, if we had time, we'd go over. But the point is, that's my job, is definitely sizing up opportunities. There's no scanning, for example. It's all just inside my head from a lot of years and a lot of hard work of getting a feel for what the market's going to do. And Archna sizes up the best option tactics in support of my trades as well as clients, and teaches about it in the afternoon sessions. So that really helps clients feel supported. So we're not doing trader education. I'm not selling any proprietary scans, any proprietary indicators. This is intelligence. This is experience. This is, trying to avoid, if you will, big drawdowns. This is why I do frequent but small allocations, but across, multiple time frames. This is how clients feel that they can, figure out what's moving, because I can see it very quickly, size up why it's moving to give it context, bullish or bearish for a direction, and then how to safely enter and exit a trade, of which finance call spreads is a really solid tactic, a very profitable one. So in kind of closing, just so you have a little bit of, we want to thank you, first of all, for showing up for this. It's exciting to offer our flavor, if you will, of advanced options. Hopefully it helps a little bit in regards to making it more understandable. And I want to just do a quick new share. We have advanced option strategies. This is for my trading room and also service, which you can't see very well, which is why I want to do a new share. Hold on. Archna, can you see this?
Yes.
The website now?
Yes.
Okay, good. So this, and if you have any questions, definitely hit us in chat. This is my website, and you can see that there's a live trading room, brokerage triggered trade alerts, newsletters, videos, option education. There's obviously a lot there for the active trader, but also for the work from home, if you will, can't be in the trading room, as well as those who are kind of investment focused and just want some good trend trading ideas that they don't have to micromanage. I did mention that there is my website, and you can see some videos here. Need to do a little bit more of that. Oops, sorry. But that's where the Gilead live session is, which is kind of fun. There, I have a Twitter account where I'm active in kind of synthesizing some or I should say, putting in context a market feel that I have based on a macro read or fundamental sentiment. Right now we have options expiration, which is a big one, coming into the end of this week. And I have written about this being kind of important, if I can find it. Hold on, we'll get there. Come on. Like, for example, we got 1.8 trillion of SPX options expiring on Friday. Now, that's not necessarily bearish because we have a nice, strong pin action at around 3,100. But after options expiration, especially on quad witching, which happens to be the third largest on record, VIX will be free, will be set free. And that could create a lot of, I know it will, it's going to create a lot of volatility into quarter end. You add on top of that pension rebalancing, which, by the way, was put on hold in March. So the last quarterly rebalancing didn't happen because we had, if you recall, we were in the middle of a 35% drawdown in the S&P. Well, they put that on hold. So now we have 76 billion of equities in pension funds that need to be rebalanced. So expect some fireworks in the end of month, which means if you're bullish, protect carefully, and don't be surprised if we have another violent pull down like we did last Thursday, where we were down 5.5% in the SPY. Yeah, so be aware. Anyway, so if you want to follow, I'm at Samantha LaDuc. I also have a StockTwits page, same thing, at Samantha LaDuc. I don't know if anyone is into getting a little bit out of your seat and sometimes clearing your head, but we have a very fun midday exercise break for traders, and it's 12:30 right after I close my trading room and before Archna does her trade education and option trade management and option education. Literally can jump in from 12:30 to 1 and get a little stretch. It feels so good. It clears the mind. The last little things I wanted to kind of bring up was in regards to the room that I run, and I have support in the form of Archna, but I also have another trading room moderator, and he is a quant focused trader. So it's very helpful to have his signals, if you will. He actually runs a book, Archna runs a book. So those signals are very helpful to identify how quants are viewing the market, because I'm not a machine. So it's very helpful. But the trading room, long story short, there are some options. You can come in for a day, for a week, the month, for the year. It's, choose how you want to fish. And when you do, there will be some advantages, if you will. You'll be able to see trade alerts, which are also sent on your phone. They're also in, these portfolios. Open trades are also listed. This is all live and it's all updated from Interactive Brokers. So you get to actually see what we're trading. And then, of course, I might be doing a whole bunch of analysis in the room and they don't all get up there as far as capturing all the trade ideas. Spotify, Roku was crazy today. There are all kinds of things that happen intraday, but those, the trading room is recorded. We have chat. We have recording of the trading room and also closed captioning in the trading room and trade alerts. So talk about transparency. It's pretty straightforward. And then for those who are interested in taking a little test drive, who are not familiar with me and my service, it is a nice little option promo here that hopefully I think David will put into chat. Oh, he just did. You're wonderful. So you get $100 off your first month, and that includes everything. So you get a much better feel for that market inflection when I see it coming. Also intraday, and then of course you get some trade ideas that you're interested in. You want some help, setting it up. Perfect. This is what we do, and give some option tactics, and also, just general ideas if you're wanting some. Any questions? That's basically, I think we ran through the gist of it. Archna, anything you wanted to add?
APT, your APT is 14% up.
Say again?
Your APT trade from today is up 14%.
Oh, sweet. See, that would have been a good finance call spread. No, but it's a directional. But that still works. So I still, by the way, really like Gilead. What is the one that I have right now? Because
FedEx and GME.
so this one though, July, it was entry day of May. Now this is where Archna would never ever have let this happen, but this was up 800% in Gilead last Monday, the 8th. It was up 800%. I didn't take it off because it was only a high of $79, and I still think it can get to 85. So instead of, 8 times, I want to double that, and I'm willing to be patient in case we get a move higher into that $85 area. So right now, this is the trade that I would place again. It's cheap now, and it's only up 235%. I think this can be a lot higher. So even though this has moved around a lot, I would place this trade again. Okay, and any other questions? APT looks good. Your pins looks good. Your pins looks great. So let me see if I can move that into. So this is the concept of, all right, this is kind of a bottom fishing play if you're bullish, pin to interest. And we're not talking valuations per se, but a whole combination of technical read, speculation in the market is very high with IPOs. This has crossed over this 10 and 21 moving average and the 30, this is what these 3 lines are in here on a weekly. This is a daily setup. This is an hourly setup. So trading intraday is basically what I call the chasing. Swing trading is right here on the daily. And then the weekly is more of my trend trading. So this popped up, it hit that yellow line, which is the 50, pulled back, beautiful shallow retest of the trend line. And so that's when Archna went long in pins. I think I did too, but mine was more directional. But here's the thing. If it was to come back inside this trend line, basically break 19 and head down, I'd be wrong. On a shorter time frame, that would be a problem for me. On a larger time frame, I would sell the 1750 puts and buy, the 22 by 28 call spread or something, further out in time. Depending on what the strikes look like, I want a debit, not a credit. Archna typically sizes that up lickety-splat fast and can suggest, a really nice return. But I have to be confident that this is really going to reach its price target within that time frame. So 25, maybe 27, higher, it's not going to happen necessarily in the next 2 weeks. So that's why July, for me, I think it can reach, 26 and a half by July. Then that's
my trade is, since your stop is 1990, I sold the $20 put, and I have taken a 23.26 call spread.
Okay.
For July.
Yep. So that's gorgeous. So that to me makes a lot of sense. And the only time it would really be in trouble is if it got back below the 10-week, the 30-week, that, weekly level, that trend line, then we're wrong, period. But otherwise it looks very supportive. So if that's the combination of using, and it's oversold relative to a lot of IPOs, which you can see are just, freaking out higher, right? Pins didn't get the memo. Nope, these are all nice and I like PD, by the way. I think that's a fabulous finance call spread in the making, but it didn't really have so much in liquidity until this week. So now it's getting a lot of action, but I think I would go maybe a little further out if there was more liquidity in August, but right now, no, I wouldn't do June. This is a directional play, but it doesn't have enough in August. to do a finance call spread to my, yeah, that's not enough. You would do it, wouldn't you? Archna would probably do this one. I want to see several thousand contracts and lots of open interest. So this is why I wouldn't do it on pins, but it is technically a lovely pattern, both for higher and for finance call spread, but you kind of have to make a market or just do, you know, a directional call. All right, I think we are done. I gave you hopefully some ideas and some education, and we have greatly appreciated the time you have spent with us. Again, Fishing Club, take advantage of this offer. See you on Twitter. Sign up if you want for some, you know, YouTube videos once in a while. This is a new site, so I need to build up some content. And happy fishing.
Thank you so much, Samantha. It was awesome as usual.